Imagine this. You want a 60,000 rupees smartphone. 10 years ago, you might have waited 6 months, saved the money and bought it. Today, the same purchase can sound very different. Only 2,499 per month, and suddenly a 60,000 purchase doesn't feel like 60,000. Then comes the credit card, and then the buy now pay later option. Then the personal loan, then another EMI, and before you realize it, your salary isn't paying for what you are buying today, it is paying for what you bought yesterday. And this isn't just an individual problem anymore. The Reserve Bank of India is increasingly watching something much bigger: India's household debt. As of September 2025, India's household debt stood at about 45.5% of the GDP, according to the RBI's June 2026 Financial Stability Report. More importantly, 58.4% of the household borrowings were non-housing retail loans by March 2026, including categories such as personal loans, vehicle loans, credit card borrowings, and other retail credit. And consumption loans now account for nearly half of the household borrowings. So the real question isn't, are Indians borrowing more? The real question is, what are Indians borrowing for? See, because borrowing 50 lakh rupees to buy a house is economically very different from borrowing 50,000 to fund a vacation. And this is a story of how India moved from a safe first economy to increasingly credit-driven consumption economy. Now let's start with the basic definition. What is household debt? Household debt is the stock of money owed by households to the lenders, either a bank or a NBFC or other financial institution. Anyone can be the lender. But there is an important distinction. Not all debt is bad. Suppose you borrow 50 lakh for a house, you acquire an asset. Or suppose a small entrepreneur borrows 5 lakh to expand a business. That debt may generate future income. But if you borrow 50,000 rupees for a holiday, 80,000 rupees for a phone, and 1 lakh through a personal loan to pay previous bills, the debt is financing consumption rather than income generating assets. That distinction is at the heart of RBI's concern. And to understand why and how India reached here, we need to go back. See, for decades, Indian households were traditionally cautious about borrowing. The cultural formula was simple: earn, save, buy. Credit existed, of course, but formal consumer credit was much less accessible. Then liberalization and financial sector reforms gradually expanded banking and consumer finance. Credit card became more common. Customer durable personal loans expanded. Personal loans became easier to obtain, and then something much bigger happened in 2014. We call it as Jan Dhan. So the government of India launched the Pradhan Mantri Jan Dhan Yojana in August 2014, massively expanding access to formal bank accounts. Financial inclusion was an important objective, but once people enter the formal financial system, something else becomes possible: formal credit. And then came the digital revolution in 2016 when the UPI NPCI launched the pilot of UPI in April 2016. Suddenly transferring money became almost frictionless, and over time the same digital ecosystem that made payments easier also makes financial products easier to distribute. See, loans could increasingly be offered through a smartphone rather than a bank branch. And then came fintech, and with fintech came something even more important: instant credit. And with fintech came something even more powerful. We call it as instant credit. Now, after all this, then came COVID-19. During the pandemic, households temporarily accumulated unusually high financial savings because people couldn't spend normally. And according to RBI data, household net financial savings jumped to 11.6% of the GNDI in 2020-21 compared with 7.6% in 2019-20. But as the economy reopened, that accumulated saving was gradually spent. And by 2022-2023, net household financial savings has fallen to around 5.2% of the GNPI or GNDI. See, in other words, the pandemic created a pool of savings. The reopening released pent-up consumption, and increasingly, consumption wasn't being financed only by savings. It was being financed by credit. Now, this is where Gen Z enters the story. Buy now, pay later, or BNPL. It's essentially a short-term credit that allows a consumer to receive a product or service immediately and repay later, often in installments. The psychological difference for this is enormous. A 30 lakh purchase feels like a 30,000 gone from my bank account. But BNPL can make it feel like only 5,000 this month. The price hasn't changed, but the pain of paying has been postponed. And digital platforms makes this extremely easy in a very few clicks. There is no branch visit, minimal paperwork, and increasingly lenders can use digital data to access borrowers. This isn't necessarily bad. In fact, Easier credit can be extremely useful. It can help someone manage an emergency. It can finance a productive installment. It can bring previously underserved borrowers into the formal financial system. But there is a problem. See, now look at the transformation. According to the latest RBI's FSR report, household debt reached at around 45.5% of the GDP, above its 5-year average of 42.9%. And the composition has changed dramatically. Non-housing retail loans accounted for 58.4% of the household borrowings in March 2026. These loans have been growing faster than housing, faster than agriculture, and faster than business loans. And nearly half of the household borrowings are now for consumption purposes. Now consider another number. At the end of March 2026, gross NPA ratios were around 0.7% for secured retail loans versus 1.7% for unsecured retail loans. Now that difference matters. A secured retail loan has collateral. If you stop paying a home loan, there is a house behind the loan. But an unsecured personal loan, there may be nothing tangible backing it. The lender is effectively betting on your future income. And if millions of borrowers suddenly face weaker incomes, unemployment, or higher expenses, that becomes a financial system problem. Now here's where the story becomes even more interesting. The riskiest looking segment isn't necessarily the 50 lakh loan. It can be the 20,000 or 40,000 loan. What's the reason? Because small ticket loans can be extremely easy to take repeatedly. The RBI's latest data shows that the fintech firms accounted for 56.8% of the personal loans below 50,000 rupees by March 2026. The credit in the segment grew by 41.6% year on year compared to 20.1% growth for the overall segment, but their delinquency rate was 6.4%. For comparison, the corresponding figure was about 5.7% for NBFC and 4.1% for the bank, and roughly 70.5% of fintech loan books were unsecured, with about half of these loans going to the borrowers below the age of 35. Now, this doesn't mean fintech lending is inherently dangerous. It means that the fastest growing part of the credit market is also one where lenders have to be extremely careful about underwriting. And now let us discuss about the Gen Z effect. Now let's come back to the Gen Z, because according to the TransUnion CIBIL data cited in the recent reporting, India's credit active population has expanded enormously. The share of credit eligible population, that is credit active, has risen from roughly 11% a decade ago to around 28% today. And the young borrowers are increasingly entering the credit system earlier. See, consumers born in the 1960s and 1970s typically entered formal credit much later. For people born in 1990s, credit activity increasingly began in mid-2000s. For those born after 2000s, the journey can begin around the early 2000s through products such as small ticket loans and BNPL. Now, this represents a major cultural shift. For previous generations, debt was often associated with a necessity. For younger customers, debt can increasingly be associated with a convenience, a concert, a vacation, a restaurant bill, a lifestyle picture. For younger customers, debt can increasingly be associated with convenience. A concert, a vacation, a smartphone, a laptop, a restaurant bill, a lifestyle purchase. The question isn't necessarily, can I afford this? It becomes, can I afford the EMI? And those are two very different questions. Now, why RBI has stepped in? See, the RBI noticed this rapid rise in unsecured consumer credit. Remember the word, unsecured consumer credit, as early as 2023. Now, in November 2023, it increased the risk weight on certain categories of consumer credits for banks and NBFCs from 100% to 125%. Now, for credit card receivables, risk weights were also increased. Now, the question is why? Because higher risk weights effectively require lenders to hold more capital against these loans. In simple terms, RBI was making banks more expensive to lend aggressively into the riskiest credit card segment, and the policy had an effect. See, RBI reported that growth in the affected consumer loan categories moderated from 23.3% in November 2023 to 13.9% by June 2024. And then RBI went with another problem after another problem: digital lending practices. In 2022, it issued digital lending guidelines addressing concerns about mis-selling, data privacy, unfair recovery practices, and the role of lending service providers. In 2024, RBI also announced a public repository of digital lending apps associated with the regulated entities. So RBI's message is not stop lending. RBI's message is grow credit, but grow responsible credit. That is what RBI is trying to say. But now the question really is that, is India really in a debt crisis? And now we need to be very careful. Headlines about household debt can sound frightening, but 45.5% of the GDP is not by itself evidence of a household debt crisis yet. India's household debt ratio remains below of several emerging economies. For example, RBI's comparison puts Thailand at around 87.3%, Malaysia at 69.9%, China at 59% of GDP. And there is another important positive signal. The RBI says the share of prime and above rated borrowers has increased, both in outstanding credit and in the number of borrowers. So this isn't a story of every Indian household suddenly becoming financially distressed. The banking system remains resilient. The problem is more subtle. The real issue is the quality of debt. Now let's just imagine two households. Household A borrows 10 lakh rupees for a house. Household B borrows 2 lakh rupees for phone, vacation, credit card bills and lifestyle purchases. Now household A has acquired an asset. Household B has acquired consumption, but still has to repay the principal and interest. This is why the composition of debt matters as much as the quantity of debt. And there is another connection. India's net household financial saving fell to 5.2% of the GDP in 2023-2024, before recovering to around 6% in 24-25, according to the government data. So the situation has improved from 2023-2024, but the broader trend still matters. If household incomes don't rise fast enough, and consumption increasingly depends on the borrowing, future income gets committed even today. And that is very tragic. Now the bigger economic question, and this is where the story goes beyond Gen Z, India wants consumption to drive economic growth. Private consumption is one of the largest components of India's GDP. So rising consumer credit can actually support growth, of course. Someone buys a car, a manufacturer produces the car, a dealer earns the income, a worker earns wages, a bank earns interest. Economic activity increases, GDP of the country goes up. So credit isn't an enemy, please understand. Credit is an economic accelerator, but an accelerator without brakes is very dangerous. If borrowing rises because of income and productivity, that's one thing. But if borrowing rises because households cannot afford lifestyle they're consuming, that's another. And if debt is increasingly used to repay previous debt, then the economy can enter a very, very dangerous and vicious cycle. Now, when we talk about India's credit economy, so is Gen Z responsible for India's rising household credit or household debt? The answer is no. That would be far too simplistic. The transformation has been decades in the making. Financial liberalization expanded credit, banking reforms expanded access, Jan Dhan expanded financial inclusion, smartphones and UPI made financial transactions frictionless. So fintechs made lending faster. COVID-19 changed consumption behavior, and BNPL, an instant personal loan, which means buy now, pay later, and instant personal loans, changed the psychology of borrowing. Gen Z is simply the first generation to experience this entire system at a digital speed. And that's why this story matters. Because India is entering a new phase of economic development. A phase where the question isn't simply how much do Indians earn? It is also how much of tomorrow's income have Indians already spent today. The RBI doesn't want India to stop borrowing. It wants India to borrow productively, responsibly, and sustainably. Because a healthy credit economy should allow households to use tomorrow's income to build tomorrow's wealth, not use tomorrow's income to pay for yesterday's consumption. And perhaps that is the real warning hidden behind India's rising household debt. The danger isn't Indians are borrowing more. The danger is if we start confusing the ability to borrow with the ability to afford. I hope you gained a new perspective from this session. Do let me know your views around it in the comments section. I'll be very happy to read them. All the very best and have a beautiful day. Thank you.